if we are about to experience, some people would say soft landing. I find it hard to believe this will be soft, but soft or hard landing, what that will mean is inflation and interest rates are going to continue coming down, and the Fed will follow them finally. The markets always lead the Fed. So that could be what's going on here. If you remember what happened, our strategies, innovation-based strategies, they started underperforming in February of 21 when the whiff of inflation and interest rates going up with supply chain issues started. And the market just started discounting, saying, interest rates are going to go up at some point. This category of stocks is not going to do well.
Cathie Wood, the CEO and CIO of ARK Invest, discusses various topics in a recent video. She talks about the recent bank crisis and the actions taken by the Fed, including an unprecedented 25 basis point raise during a crisis. She expresses concern about the Fed ignoring economic indicators and market signals, and discusses the upcoming 25 basis point rise in early May. She also believes that raising the debt ceiling is imperative, and may come sometime in June. Wood discusses monetary policy and notes that M2 growth has dropped 30 percentage points, resulting in negative year-over-year M2 growth, which has not been seen since the 1930s. She takes this seriously and has been warning about it for a year. Wood mentions the possibility of a slow-moving crisis or hard landing, which the markets are currently trying to figure out.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The debt impasse still seems to be out there, and it looks like raising the debt ceiling, the imperative will come sometime in June, we think. So we'll have another few months. It doesn't seem like there's much movement at all. And yet we know that Republicans and Democrats don't want to go through another 2011 where the ratings agencies downgrade our debt. So we assume they'll figure it out, but so far, very little movement there. The one thing that is becoming clear, and this is really a throwback to the early days of my career, the bank crisis seems to be facilitating, in a sense, what we used to call crowding out back then. Really, the public sector crowding out the private sector. And how is that happening? Well, we're seeing deposit outflows from the banking system, so that's the private sector, into money market funds and especially treasury securities, a little bit of a flight to safety. So what is that doing? It's actually accommodating spending, government spending. And so we're watching this carefully. If it's accommodating government spending, what will it be crowding out? And we'll get into this in a moment, but it does seem already that the commercial real estate space is one of the victims. So this could be just a slow-moving crisis. We don't know. But getting into monetary policy, it could be a slow-moving crisis, or are we talking about a hard landing? And I think, the markets are a little bit on pause now, trying to figure out, did the Fed and the FDIC come in and, rescue the banking system from a run on the banks? So far, so good. But I do think the markets are stepping back and saying, is that all there is? What else could happen now? And there are a lot of things we think that could happen now. We all know, of course, it was the regional banking system. And it has highlighted two major mistakes that banks made. Both of them actually were very understandable, but they were mistakes nonetheless. And they made those mistakes in the middle of COVID, as the crisis was unfolding. They took a look at the Fed's forecast through the end of this year and saw that the Fed was forecasting that interest rates would go nowhere. They'd stay very, very low, move hardly at all. And so it made sense back then to take the gusher of money coming out of fiscal stimulus and ending in bank accounts and put that in very safe, long-term, government-backed securities, yielding 1.5% or so. Remember back then, the Fed funds rate was 0 to 0.25. So it made sense back then. So the first assumption they made was that interest rates would not go up very much, if at all, which is what the Fed was telegraphing. And of course, in 2022, and over the course of just 1 year, interest rates went up 20-fold. Never happened before. 20-fold, up to 5%. And that was a shock to the banking system because with such low yielding securities on the asset side of the balance sheet, it was very difficult for them to pay up for deposits on the liability side of the balance sheet. And so what happened? What happened was deposits flowed out and into money market funds, so out of the banking system.
Cathie discusses the possibility of a soft or hard landing, which the market seems to be considering. She suggests that this could result in continued low inflation and interest rates, which would benefit technology and innovation-based stocks. Additionally, she notes that the yield curve is indicating that we are not out of the woods yet, and that the Fed's mistakes could lead to further ramifications. Let's return to the video.
Most of the statistics that have come out recently, that they were taken, or the measurements were taken pre-regional bank crisis. So I'm not sure we should pay too much attention to them. The positive ones were on housing, and I think it's because mortgage rates have come down since the long-term Treasury bond yield peaked last October at 4.3%. Finally, mortgage rates started to come down. So housing starts, permits, mortgage applications, existing home sales, and pending home sales all have done a little better. I mean, housing by many measures was down 40% year over year. So I suppose we shouldn't be surprised to see some rebound there. Autos they're still in recession territory at 14.82, but they came in a little better than expected. But other than that, even before the crisis, a lot of indicators were starting to signal trouble. So employment indicators like job openings have come down fairly dramatically. They peaked at 12 million at one point. Now we're down to 9.9. The Challenger Job Survey of layoffs, which are the larger layoffs, that's up more than 400% year over year. And maybe the most important indicator is initial claims, which were revised recently. And at turning points, as I've mentioned on this webinar before, at turning points, we see massive revisions. Well, such was the case with initial unemployment insurance claims, and that's a weekly indicator. So we have some of those since the crisis, and the revisions are up 25%. 25% in an indicator that the Fed's really paying a lot of attention to, and so are the financial markets. So that was kind of interesting. And then if you look at the various regional Fed indices, they're all disappointing. So the Philly Fed, the Dallas, Richmond, and so forth. The 10-year Treasury bond yield peaked in October last year, 4.3. It did get to 4.1% in March, but then the crisis took care of that. And we're now down to roughly 3.5%. So we're down to 3.5%, perhaps because of a flight to safety, and perhaps because whatever kind of landing this is going to bring with it lower inflation and interest rates. And if deflation is the risk, that actually accrues to the benefit of stocks that do well during deflationary times. And that tends to be technology. Technology technologically enabled innovation is deflationary. Now, the yield curve is telling us that we're not out of the woods yet either. It did drop to more than 100 basis points of inversion on March 8th, and the crisis took care of that. But we're still inverted at 58 basis points today. So now many people looked at the 100 basis points and they said, oh, well, the last time we were here was in the early 80s. We got inflation under control with 100 basis points inversion back then. And that's true. But I think the analysis is a bit off. It basically underestimates how powerful Fed restraint is today, because 100 basis points or 1% against a 15% long bond yield is a lot different from 1% against a 4% bond yield. So 1 over 15 is 6.5. Use the Richter scale here. 6.5 on the Richter scale is a pretty powerful earthquake. I've been in a couple of those, and they are not pleasant. They're actually quite eerie. 1 over 4 would be 25 on the Richter scale. We've never seen an earthquake of that magnitude. In fact, I think the highest has been 10. So I think if we look at it from that point of view, that the Fed has been making a mistake, and we are going to see more ramifications of this.
In the video, Cathie Wood discussed the current state of the economy, including monetary policy, fiscal policy, economic indicators, and market signals. She expressed caution and awareness of the risks and uncertainties that lie ahead, while also remaining cautiously optimistic about the market. Cathie highlighted negative year-over-year M2 growth, credit default swaps, and the yield curve inversion as indicators of a possible slow-moving crisis or hard landing. She believes that deflationary indicators are beginning to fill up the pipeline, and the greater risk out there may be deflation. In other news, Fox News has agreed to pay Dominion Voting Systems, a technology group, $787.5 million for defamation following the 2020 presidential election. The settlement was made in Delaware before Murdoch and other Fox executives were forced to testify publicly. This is a significant financial and reputational blow to Murdoch, the biggest since the closure of the News of the World in 2011, a phone hacking scandal estimated to have cost News UK more than £1 billion. The bill for spreading Donald Trump's conspiracy theories is also bound to rise, as Fox faces a $2.7 billion claim from Smartmatic, another voting technology group, and potential investor lawsuits. The enigma of the Dominion debacle is why Murdoch failed to block Fox hosts such as Lou Dobbs from entertaining the vote rating claims made by Trump's lawyers, Rudy Giuliani and Sidney Powell, after Trump lost to Joe Biden. The overall global financial outlook is cautious, as general market indicators point to a heavy financial crisis, while some experts spark rumors of a soft landing. It remains to be seen what the next pivotal move will be. Let us know in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.